U.S. nat gas futures are sliding lower on Tuesday, erasing Monday's gains as traders factor in the impact of China's latest retaliatory tariffs on U.S. energy exports. China has announced a 15% tariff on U.S. liquefied natural gas and coal, effective February 10, in response to President Trump's new tariffs on Chinese goods. While this move doesn't directly impact the domestic natural gas market, it raises concerns about global LNG demand and could slow U.S. export growth. As the world's largest LNG importer, any reduction in China's demand for U.S. LNG could pressure prices, particularly with global markets already dealing with strong supply levels. The tariffs also come at a time when mild weather in Asia is keeping spot LNG prices under pressure. Further weighing on the bearish outlook, a new pipeline delivering Russian natural gas from eastern Siberia to China's densely populated northern and eastern regions began full operations on Monday. Spanning over 5,111 kilometers, the East Route pipeline is set to supply up to 38 billion cubic meters of natural gas annually, serving around 450 million people across 9 provincial regions. Additionally, over the past year, a 30-year gas supply agreement was signed to construct another pipeline, further expanding Russia's gas export network beyond the existing Power of Siberia pipeline. As you can see, the two Power of Siberia pipelines together are set to reroute nearly all Russian gas from Europe to China. This shift will significantly reduce U.S. LNG exports to China, potentially flooding the U.S. market with surplus cheap gas, which could push prices back down to $2. Of course, there's no doubt that any U.S. administration will try to prevent this, but I believe it won't be as easy a task as it was with the Nord Stream pipelines. Meanwhile, over the weekend, weather models trended colder, adding 20 to 25 heating degree days, which initially fueled Monday's price surge. However, the market has since erased those gains, suggesting that traders remain skeptical about weather-driven demand being strong enough to push prices higher in the near term. On the supply side, average U.S. nat gas production in the lower 48 states has climbed to 105.7 billion cubic feet per day so far in February, marking an increase from January's average of 102.5 billion. This steady rise in output reflects improved operational efficiencies and strong upstream activity. From a technical perspective, the market's ability to hold above the key support level of $3.30 points to further upside potential, particularly if additional cold weather patterns emerge. On the upside, the 50% retracement level at $3.50 is the next key resistance. On the downside, support is seen near the $3 mark, aligning with the 100-day moving average. A decisive drop below this level could trigger increased selling pressure, potentially driving prices toward the $2.75 support level. Please like, subscribe, and comment to support the channel. See you in the next one.